Picture this. Throughout 2025, the biggest banks on Wall Street, Goldman Sachs, JPMorgan, you name it, were all calling for the dollar's decline. And they were right. The dollar had its worst year in over a decade, dropping nearly 10%. Then, in the middle of 2026, something flipped. The dollar staged a sharp comeback and is now trading at its highest level in 14 months. So what's actually going on? And if you're holding savings, investments, or just planning a trip abroad, what does this mean for your wallet? Let's break down the whole story. What the dollar index actually measures. First, let's clear something up. When people say the dollar is weakening or strengthening, they're usually talking about the US dollar index, DXY. It's a number that tracks the dollar's value against 6 major currencies: the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. The euro carries the heaviest weight, around 57%, so DXY moves are largely a euro versus dollar story. When DXY rises, the dollar is gaining strength. When it falls, the dollar is losing ground. Why the dollar crashed in 2025? Let's start with why 2025 was such a brutal year for the dollar. 3 main forces were at play. First, fiscal concerns. Growing U.S. government debt and deficit spending shook investor confidence in long-term economic policy. Second, the Fed cut rates. The Federal Reserve trimmed interest rates by about 75 basis points in 2025. Lower rates make dollar-denominated assets less attractive, so investors moved their money into currencies offering better returns. Less demand for dollars meant a weaker dollar. Third, de-dollarization. This is a bigger structural trend. Countries, especially the BRICS bloc, started settling more trade in their own currencies instead of dollars. Central banks worldwide began selling dollar reserves and buying gold instead. In January 2026 alone, central banks net sold $48 billion in dollar reserves, while picking up 150 tons of gold. Add it all up, and by September 2025, the DXY had dropped roughly 10%, down 13.5% against the euro and nearly 14% against the Swiss franc. Why the dollar suddenly bounced back in 2026? Here's the twist. By June 2026, the dollar had completely reversed course. The biggest driver, inflation, roared back. In May 2026, headline U.S. inflation hit 4.2%, the highest since April 2023, largely fueled by a Middle East-driven energy shock that pushed energy prices up more than 23% year over year. With inflation running that hot, the Federal Reserve, now under new chair Kevin Warsh, hit pause on rate cuts. In fact, markets are now pricing in the possibility of rate hikes, potentially as early as September or October. When a currency's interest rates are expected to rise, investors pile back in, chasing higher returns. That's exactly what happened. Money flowed back into the dollar, pushing DXY past 101, its highest level since May 2025. What this means for your money. Now for the part that actually matters to you. 1. If you hold international or dollar-denominated investments, a stronger dollar can eat into returns from foreign assets when converted back to dollars. If you positioned your portfolio expecting continued dollar weakness, this reversal caught a lot of people off guard. 2. Travel and overseas spending. A stronger dollar is actually good news here. Your dollars stretch further when converted into euros, yen, or pounds. If you're planning international travel, this is a small silver lining. 3. Gold and commodities. Normally, a stronger dollar makes gold and commodities cheaper since they're priced in dollars. But right now, geopolitical tension is also driving safe haven demand for gold. So you've got two competing forces pulling gold prices in different directions at the same time. 4. Emerging markets and global portfolios. A strong dollar tends to pull capital out of emerging markets, as investors chase better returns at home, which can pressure those currencies and equity markets. Will this trend continue? Honestly, even the experts are split. Banks like Goldman Sachs and Deutsche Bank still believe the dollar's longer-term trajectory is downward. Their forecasts have DXY drifting back to the 98 to 100 range by the end of 2026, roughly a 3 to 5% pullback from current levels. But it all hinges on two things. First, how inflation data trends over the next few Fed meetings. Second, whether the Middle East ceasefire holds and keeps energy prices in check. If inflation cools and the ceasefire sticks, the Fed could resume cutting rates and the dollar could soften again. If inflation stays elevated, expect the dollar to stay strong for now. What you should actually do with this information. If you're making a big decision tied to the dollar, international travel, sending money abroad, or adjusting your investment allocation, keep this in mind. Short-term dollar moves are genuinely hard to predict because they're driven by both geopolitics and Fed policy, both of which can shift month to month. For long-term investors, the standard advice still holds. Diversify. Don't bet everything on dollar strength or weakness. A mix of gold, global equities, and domestic assets helps smooth out this kind of volatility. Closing CTA. So that's the full story. The dollar's crash in 2025, its surprise comeback in 2026, and the forces driving both moves. If you found this useful, hit like and subscribe, and let me know in the comments. Where do you think the dollar goes next? Up or down?